Welcome to the Real Estate Channel. Rising interest rates. This is a hot topic lately, especially in the real estate market. Interest rates have been at historic lows for years, but in the past few months the Federal Reserve has started raising interest rates consistently in order to curb inflation. Higher interest rates can have a significant impact on the real estate market, affecting home sales, home values, and the overall health of the industry. In this video, we will take a deep dive into the subject of rising interest rates and their effect on the real estate market and home prices. So sit back and relax, and let's get an understanding of how rising interest rates may affect your decision to buy or sell a home. First, let's discuss why interest rates are rising. The Federal Reserve is responsible for setting the federal funds rate, which is the interest rate at which banks lend money to each other overnight. When the economy is strong, the Federal Reserve may raise the federal funds rate to prevent inflation. Inflation occurs when there is too much money in the economy, causing prices to rise. Raising interest rates is one way to combat inflation. When interest rates are higher, borrowing money becomes more expensive. This means that people are less likely to take out loans, which can help reduce the amount of money in circulation and keep inflation in check. So, how do higher interest rates affect home sales and the real estate market? The most obvious impact is that higher interest rates make borrowing money more expensive. This means that home buyers will have to pay more in interest, which can make buying a home less affordable. This, in turn, can lead to a decrease in demand for homes, which can cause home prices to fall. However, higher interest rates can also have some potential benefits. For one, higher interest rates can lead to a stronger economy. When interest rates are low, people are more likely to borrow money, which can lead to an oversupply of money in the economy. This can lead to inflation and weaken the economy in the long run. By raising interest rates, the Federal Reserve can help keep the economy on a more stable footing. Higher interest rates can also be beneficial for those who have savings accounts or other types of investments. When interest rates are higher, these investments can earn more money, which can help investors grow their wealth. So, how does the real estate market behave during and after periods of higher interest rates? The answer is complex and can vary depending on where you live. In some parts of the country, rising interest rates may have little impact on the real estate market. In other areas, higher interest rates may cause home prices to fall or make it more difficult for people to buy homes. In general, the real estate market tends to be more sensitive to changes in interest rates when home prices are already high. When home prices are more affordable, rising interest rates may have less of an impact. If you're a home buyer or seller, what can you do to prepare for rising interest rates? For buyers, it's important to understand that higher interest rates can make buying a home more expensive. This means that you may need to adjust your budget or expectations to reflect the higher cost of borrowing money. It's also a good idea to get pre-approved for a mortgage before you start shopping for homes so you know what your budget is. For sellers, rising interest rates may mean that you need to be more flexible with your pricing. If home buyers are less willing to take out loans, you may need to adjust your asking price to reflect the lower demand. You may also need to be patient and wait for the market to adjust before you can sell your home. It's also important to remember that rising interest rates are just one factor that can impact the real estate market. Other factors, such as changes in the economy or job market, can also have a significant impact on home sales and prices. It's worth noting that the Federal Reserve and the government have printed trillions of dollars during the COVID pandemic, which has caused massive inflation. This has led to concerns about the long-term health of the economy and the real estate market. However, it's important to remember that the impact of inflation on the real estate market is complex and can depend on a variety of factors, including the overall health of the economy and the specific housing market you're looking at. One potential impact of inflation on the real estate market is that it can cause home prices to rise. When there is too much money in circulation, people may be more willing to spend money on big-ticket items like homes, which can drive up demand and prices. However, inflation can also make it more expensive for people to borrow money, which can decrease demand for homes and lead to a decrease in prices. It's also worth noting that inflation can impact different parts of the country differently. Areas that are experiencing strong job growth and a high demand for housing may be less impacted by inflation than areas that are struggling economically. So, what can home buyers and sellers do to prepare for potential inflation and its impact on the real estate market? One important step is to stay informed about economic trends and how they may impact the housing market. This may involve working with a real estate agent who is knowledgeable about the local market and can provide insight into trends and forecasts. If you're a buyer, it's important to be flexible and patient when it comes to finding a home. Inflation can impact the affordability of homes, so you may need to adjust your budget or expectations to reflect changing market conditions. It's also important to get pre-approved for a mortgage so you know what you can afford and can act quickly if you find a home you want to purchase. For sellers, it may be helpful to work with a real estate agent who can help you price your home appropriately given changing market conditions. You may also want to consider making upgrades or improvements to your home to make it more attractive to buyers, particularly if demand is lower due to inflation. In conclusion, rising interest rates can have a significant impact on the real estate market, affecting both home sales and the overall health of the industry. While higher interest rates can make borrowing money more expensive and lead to a decrease in demand for homes, they can also help keep the economy stable in the long run. The impact of inflation on the real estate market is complex and can depend on a variety of factors, including the overall health of the economy and the specific housing market you're looking at. By staying informed and working with knowledgeable professionals, both buyers and sellers can navigate changing market conditions and make informed decisions about buying and selling homes. Thanks for watching. We hope you found the information in this video both informative and enjoyable. Be sure to like and subscribe to our channel so you never miss out on new real estate content we produce weekly. See you in the next video.